Let's get across the market open. Scott Phillips joining us in the Motley Fool. Scott, happy Friday. Good to see you now. Of course, all eyes again on Trump's tariffs. How should investors be looking at this? Because it's on again, it's off again. I mean, that uncertainty is just continuing given now we've got a court battle going on.
Yeah, that's right, mate. We had yesterday some hope that maybe the tariffs will be struck down by the US Court of International Trade in the event. The appeals court has said they can go ahead, at least while that appeal is heard. There's so much more to come. I think, look, here's the thing. We should be used to this by now. We've seen the tariffs come and go over the last few months. We've seen them put in place at a I was going to say reasonable level. They're not reasonable. At a smaller level, then Trump, of course, ramps it up, backs them down, pauses, delays, negotiations, truces, all that kind of stuff. The court case is just another one of those, really. And I think to your question, investors have got to make their peace with that volatility. That's actually how to do it. Trying to trade this one is mad. Even overnight in the US, the future up 1.6% at one point because it was going to be all great. Then, of course, the news came through that the appeals court had effectively put aside the judgment until the appeal was heard. So you've got these, on again, off again realities. I think I said to you the other week, the fluctuation in the US stock market has been mad. That 9% gain on one day, big falls on other days. By the way, as of Wednesday this week, I haven't checked it since, the S&P 500 was back in positive territory for the year. And so for everything we've seen over the first 4 months of Donald Trump's presidency, for all of the, frankly, damaging stuff that he's done, economically at least, we're now back ahead of where we started the year. Not ahead of when Trump took office, to be fair, but ahead of where we started the year. And that's probably, I hope, a key insight for your viewers to say, you know what, if you think about where investors are making their bets, trying to bet on what's going to happen, who, by when, to what degree, in what stocks, what industries, what economies. It's madness, mate. I think, really honestly, trying to bet it, trying to trade it is silly. So I think you got to look through it. As a long-term investor, you'd expect me to say that anyway. But realistically, as I said before, in 5 years' time, Trump is gone. Someone else is in the White House. Maybe the tariffs are there, maybe they're not. Whatever happens, it's very, very hard to know the ramifications of not only what we've seen to date, including overnight, but we'll see for the next 3 years and 8 months of Trump's presidency, and then whatever happens after that. So what you really can do is focus on the things that are worth knowing. Howard Marks from Oaktree Capital famously talks about that 2x2 grid. There's knowable and unknowable, and there's important and not important. And if stuff's important but unknowable, there's no point worrying about it. You just got to kind of accept that you got to roll with the punches. So that's the honest answer for investors, mate, is roll with the punches. Don't be overexposed to any of those particular risk areas. You can be a bit prudent. You should have been already meaningfully diversified across industry, geography, currency, all that kind of stuff anyway. But if you're not, a nice opportunity, particularly with that recovery in share prices recently, just have another look at your portfolio and say, hey, am I really diversified properly? Am I exposed to not only those usual things that we think about, again, industry, currency, geography, but individual risk factors, whether it's consumer, whether it's business, whether it's trade, whether it's whatever. Just a really good chance to have a look at it. Don't be diversified to the point of having one of everything, otherwise buy an ETF and go fishing. But just be sensibly diversified across your portfolio. Think about the potential risk factors and just moderate those. Not because you know what's coming next, but specifically because you don't.
Well, what do you make, though, of the buoyancy we're seeing on share markets at the moment? Clearly, investors opting for a optimistic view of what they're seeing at the moment. And I guess, we look at what happened overnight on Wall Street. Nvidia, it was all about that, wasn't it? Really pushing the market higher.
Yeah, $70 billion in quarterly sales from Nvidia. That is astonishing numbers. $280 billion a year, effectively on a run rate basis. And who's to say they're not going to grow on top of that, run rate wise? They're now, again, the US's most valuable company, at least by market capitalization. The numbers are phenomenally big. They make 72% gross margins. They're keeping 72 cents in every dollar of sales. Now they're paying some development costs and infrastructure costs and other things with that stuff. But if you can take your cost of goods sold as a chip maker, and keep effectively 4 times that, or sell for 4 times that, you're in a very, very good place. Does give you a little bit of a moment for pause, Andrew. I have to say, I like being the optimist in the room of pessimists. I don't like being the optimist in the room of uber optimists. And I've got to say, for Nvidia right now, I don't know what happens next. I have absolutely no idea. But if you think about the value of the company, the growth that's expected, the margins they're making. Remember, Jeff Bezos' line is, your margin is my opportunity. Maybe Nvidia always gets to charge 72% margins. Maybe they always lead, and maybe they've always got massive sales growth coming. But if there is a second or third tier player that can produce relatively similar chips for meaningfully cheaper prices, Nvidia's business model is not going to be broken, but the profitability of that business model is one we have to question. So I don't know what's going to happen. I'm not saying short the shares. I'm not saying sell them. I'm saying I'm not going to buy them at the moment for that reason. It's just everything. The tide is all the way in. It's not with Tesla, by the way, the same kind of thing in the past. So when the tide's all the way in, Where's it going to go? Well, maybe it goes in a little bit further. Maybe you get a king tide to torture the metaphor, or maybe the tide starts to go back out. So be a little bit careful there. But that's not to say AI is not going to be a massive thing. The boom in AI is going to go for years, in my view. Whether that means, and by the way, where that value goes is a hard question to answer. We talked so many times before about airlines, right? 1970, if you'd said to me the next 56 years, air travel is going to expand by whatever the number is, some stupid number of orders of magnitude, you would have sold everything and bought airlines, right? And you would have lost a fortune. So being careful about the theme versus the investment opportunity is really, really important. We've seen it with lithium. You and I were talking about lithium for years, and I've been, thankfully, this time right, saying to people, you know what, just be careful because the demand side is pretty much spot on. The supply side, if we get a supply response, we'll have lower prices. That's exactly what's happened. Not because I could predict it. Again, I didn't say it would happen. I just said in that sort of circumstance, just be careful that the supply response doesn't come and get you. AI-wise, maybe we end up with the same thing. So good luck to NVIDIA shareholders. It's been extraordinarily successful. America's most valuable company. I would be a little bit cautious when all of the expectation is that things are going to be rosy from here on.
Scott, let's refocus on what we're seeing locally. I see you pointing out Eagers, which has been doing well, certainly off the back of that exclusive deal it's had by selling BYD. Well, it's lost that exclusivity now.
It has. So this is really interesting, right? Talk about AI and EVs and Tesla. BYD has done an extraordinary job of muscling its way into the Australian market in particular, but other markets besides. A few models, including their new Ute, seems to be doing really, really good business. Partly, I'm sure, because Elon Musk is on the nose with a lot of potential EV buyers. Partly just because it's a cut price offering with a big range of solutions for people. You know, whether it's an SUV, a sedan, a Ute, as I said, they've done a really, really nice job of it. So, full credit to Eagers and the team. EV Direct was the business, and it was a joint venture between BYD and Eagers. Again, they've done a fantastic job. The problem with being someone's distributor is if you do too good a job, they say, thanks, we're going to take that over now. And that's exactly what's happened. So BYD has basically taken over the import responsibilities for that EV Direct business. They're now going to be the importer themselves. The opportunity for Eagers remains in the distribution. So we'll have to see how that nets out. It's hard to know whether it was acrimonious or a reasonable split or how the deal was done. Hopefully for Eagers shareholders, you do end up with a decent ongoing need or requirement for that distributor business to be provided to individual car buyers, and that continues to take them to higher heights. There is real Eagers has done a great job in growing its business. The question around, do we end up with these showroom sales, like a Tesla type sales thing where you don't have dealerships as such, you have company showrooms? That's still an open question, and I don't know how the currency continues to evolve from that perspective. So many new EV brands, so many new brands just in general, right? Particularly out of China and Asia. The market has been turned on its head. Eagers' challenge is to remain relevant in that space, to not get caught selling the old brands only, to find a way to sell or provide some of those newer brands to people who are looking for those cars. So a bit of a challenge. I think Eagers is up to it. They've done an extraordinary job, as I said. Nick Politis, the chair, is a very, very savvy businessman. Also the chair of my Roosters, by the way, so pretty happy about that. But it's a challenge for the company. Their job now is to work out how to exist and thrive in a larger EV world. It's not going to be EVs tomorrow, but it doesn't have to be EVs tomorrow. If EVs take slight amounts of market share and your business goes backwards as a result, you've got to find a way to grow. Hopefully for them, the BYD business is able to be sustained as a dealership model for Eagers.